congestion, which is what we had April, May, June, July. You know, at 5 months, gold went dead sideways in about $150, $200 range. They kept selling, couldn't get it down. It kept coming back up. Finally, it took off. No, you're not going to have any more protracted congestion zones. You can have sharp sell-offs from time to time, and maybe somewhere in the middle of the next 6 months, you're going to have a pullback that actually involves a month, not just a week. Okay. But right now, we're not at that point. The action last week, to a large extent, put us in a position where in our weekend report, we suggested that was probably mostly it. Okay. Now, the only problem was gold hadn't taken out a prior week's low. And so we finally did. I mean, that means we got under 4,000. Okay. It's back above there now. I think the cleansing we just had is probably about exhausted. And that when you flip back up, it's not going to take you 3 months to get back to the high. It might take you a week or so. Okay. And I think when that happens, people say, well, golly gee, they did it to me again. They fooled me. We're in an accelerated mode, but there's certain other huge technical triggers that actually imply fundamental triggers that we included in our weekend report. And I don't know if you can show those.
Keep talking and I'll look to that.
Okay. On page 1, we had a technical situation. Yeah, here we go. Spread chart. There you go. Now, what this chart shows, if you can get even closer to it, it'd be good. If not, what it shows is gold going back to about 2013, plotted in its percent relationship to the S&P 500. Okay. The biggest bull market out there right now. U.S. market is the bubble. No other market in the world matches what we've done. Okay. Since 2009 low. But anyway, gold is in decline since its 2011 peak in price, but also relative to the S&P. It kept coming down, and here we start in 2013. And in 2015, late in 2015, gold made its price low, under 1,050. Well, that's when the spread dropped down to about 50%, that first sharp low you see there. And then you rallied up, okay, and you got distributed into, back down again, lost more ground versus the S&P, got down around 40% of the price of the S&P, then shot up again to that plus 60 level, got bagged again, back down to 40%, and then based for a couple years. And we broke out of that base early this year and ran up again where? To the green line that was developing as a structure. And sure enough, in April, when gold paused, as you noted, when we went sideways for multiple months, the spread backed off a bit, meaning gold lost some ground versus the S&P. And then when the recent reassertion of price back out above that 3,500 price level also drove the spread back up. Now, this spread reading you're looking at there was as of Friday, and it's probably backed off a little bit as of today. But at the end of this month is when we plot that final reading. Now, if you're at 60% or higher, and right now we were about 61 as of Friday, and which gold divided into the S&P, 61% of the price. You're at one of the highest levels on gold versus the S&P going back 10 plus years. Meaning, in reality, gold is doing better than the S&P has for the last decade, but nobody notices that. But if you close credibly over that green line, which is now 1, 2, 3, 4-point trend structure, that is a massive relative performance breakout by gold versus S&P. Given the depth and the width of this base, and this is price versus price, so it's effectively a price chart, this has massive upside implications in terms of a shift in the money flows that go into gold and go out of the stock market. We're already seeing that. Gold's up a lot more than S&P over the last year, last 3 years even. So there's already been some money flow, but the average guy ain't in this market yet. And when this thing breaks out, we bet a couple things. One, gold's going to vastly outperform S&P going forward, probably for several years. It's going to be quite dynamic when it first comes out of here. It'll be like a whoosh effect. But you'll also start to get, probably a few months after this breakout, you'll start to get the headline type things that somewhat explain what is already happening. And we suspect those headline type things might be coming from the financial sector, where few people are looking. They're all looking at NVIDIA, okay? But anyway, forgetting the fundamentals, this tech to us, one, gold has been beating the S&P basically for the last 10 years because it's at the highest level in that period. And two, it's breaking out, meaning this relative valuation says it's only just begun. It's not not late, it's beginning. That's a point that we've noticed in especially our momentum work, is that when you build a structure that smacks you in the face with its clarity, like a spread structure or a momentum structure, not so much price. Price is often illusory because that's what everybody sees. And when everybody sees something, sometimes it's not right. Okay. But on a spread, which very few, I've not seen this in any financial publication, okay, or on CNBC or Fox Business. We've been watching it for a while. And when we set that structure in April and then backed off, that in effect told us, boy, do you have a real clear structure. You don't build something like this to wave goodbye to it. You build something like this as a starting gate to engage something new. And that's what we've done. And sure enough, we're out above there. And if we don't get out above there on this month's close, I bet we'll be out above there next month. You don't build this kind of thing and fail at it again. Too many hits. You're going.
Okay.
Okay.
Okay. So based on your experience over the decades, when you see a structure like this, it is inevitable. It may not be right now, but it's inevitable. Okay.
Yeah, and it will be soon because this thing is ripe as a beast.
Okay.
And we know the dynamics out there are quite strong now. So this spread, when it breaks out, though, it does say one thing that most people aren't acknowledging. It's just beginning. Well, I expect them to go higher with gold, and I think they'll probably be a better performer over the next year or two than gold will be in terms of percent gain. But just look at GDX, for example. I mean, go back to 2011, it had a high in the 60s, okay? And then it dropped down, and where was it about 5-6 months ago? No, actually back about in June, okay? It was well below the old 2011 high. Heck, gold was way out above it already. And it was trading in the 40s, GDX. You went from 40 something to 85 a week or so ago. And you got a slam dunk $10, $15 pullback. Still way above the peak of 2011. You had a thin air pullback. Didn't break anything. It just says, golly, I doubled I doubled plus in a matter of handful of months, and I can't have a sharp pullback? Does that change the world? What do you think it's going to do? Go up every single month, every week? No, it's going to have pullbacks. And because you were in thin air, well above the 2011 high, which was like, we didn't even get to it this week when we pull back into the high 60s. That's down to lower 60s. It's allowed to do that. It doesn't change reality. After all, it doubled plus in a handful of months. Can't it have a bad week? Okay. If you can't take that, you don't belong in these markets. Okay. You won't be able to catch the big move. Yeah, we've had, silver dropped hard 1 week last week, okay, and some follow through this week. So prices only dropped for 1 week, but when we run weekly momentum, which is also in this report, you made a high on weekly momentum 5 weeks ago. So momentum has been correcting, pulling back. What I mean by that is that when you measure the price of silver versus, for example, a 3-week moving average. So you have the rising price and the 3-week average is rising underneath it. When you slow the pace of the advance, even though it's still strong, at a lesser pace than the rise in the 3-week average, then you're going to get a momentum decline. Last week was week 5 down on momentum. And you got into what we call an oversold situation with only that one bad